Welcome to our banking series. In this first installment, we pull back the curtains on how the South African banking system really works. From the gold-backed notes in the 1800s to today's digital money conjured out of thin air. The system has definitely changed, but the cost to you has only grown. This is the story about how banks create money from nothing and how that quiet trick makes you poorer every single day. Let's get into it. This episode is sponsored by Stokvel Gold, our partner for gold and silver purchases. Now, if you want to start your journey to accumulating either gold or silver coins, click the link in the description below and the Stokvel Gold team will find you the lowest prices in South Africa. Welcome to the Money Revolution. This is the podcast where we empower one another to build wealth through the sharing of information and ideas about how money really works. I will once again be your host, Masijela Waramantu. And in today's episode, this is the first installment in our Understanding Banking series. We will build on the basics from episode number 9 and show you how banks create money out of nothing, thereby creating inflation and making you poorer. But first, some banking history of South Africa. The oldest surviving bank in South Africa is what we know today as First National Bank. It began as the Eastern Province Bank back in 1838. Now, in those days, banks used to own their very own banknotes. And these notes had to be backed by gold. Essentially, a banknote was a promissory note, a promise to the bearer that they can exchange that note for an equivalent amount of gold. This meant that a number of notes in circulation could never at any point go above the amount of gold that was in storage. This gold-backed banking system in South Africa continued up until the First World War. After the First World War, in between 1914 and 1918, everything absolutely changed. As we discussed in our earlier episodes, the prices of gold soared significantly in Europe and remained relatively low here in South Africa. And this created a very huge opportunity for gold traders. Smart gold traders would convert their SA gold-backed notes for gold, and they would take that gold and sell it in London at a profit. This withdrawal of gold from South African banks to London created a local shortage of gold here in South Africa for SA banks. And if you remember, these banks were never allowed to issue banknotes beyond the reserves of gold that they had. Now, the banks found themselves in a position where now they themselves had to go to London to go and buy the gold at a premium price. And mind you, this is the same gold that was being mined here at the Witwatersrand gold mine here in South Africa. By 1919, the South African banking system had found itself in limbo. They then decided to ask the government to release them from the obligation of holding gold to back their banknotes. This request resulted in the Gold Conference of 1919. And a year later, in June 1920, the South African Reserve Bank was established. From then on, the South African Reserve Bank had the sole responsibility of issuing bank notes. And essentially, these notes were still backed by gold. But in 1932, South Africa officially abandoned the gold standard. In fact, they did it way before the United States of America. Since 1932, the South African currency has had no gold backing. It's what we call today fiat currency, meaning that its value is declared by law and backed by nothing but the public's confidence and state enforcement. Fast forward to today, fiat currency has allowed banks to create currency easily without having to mine either gold or silver to keep in reserve. Back in episode 9, we revealed how banks create currency out of nothing. And today, we will deal with a much more practical example just to highlight exactly how this is done. Now, modern banks are required to keep in reserve just 2.5% of the money that they lend to the public. So, for a bank to lend out 10,000 rands, it only needs 250 rands in cash reserves. 9,750 can be lent out from money that the bank actually does not have in reserve. They do that by simply typing in a number on a computer and then voila! That is nearly 40 times more than its actual cash reserves. Now have a look at what happens when that scenario is at play. Let's say that Bank A has 250 in reserves. It can lend out a maximum of 9,750. Now, let's say it lends 975 rands to exactly 10 people. That's obviously equivalent to 9,750. And those people decide to deposit that 9,700 rands into Bank B. By virtue of this principle, it means that Bank B now has 9,750 in its reserves. And then it is allowed to issue loans worth 380,250 rands. Now, let's assume that those borrowers then decide to deposit that money into Bank C. Now, Bank C will then be allowed to issue out loans that are equivalent to 14,018,800 rands. Now let that sink in. 14 million is created only from 250 rands that is in reserve. With every loan, new currency is being created. The loan is not money that other people have in their deposits. It's just money that is being manufactured out of thin air. The abracadabra, the magic. So now back in episode 4, we spoke about how increasing the currency supply leads to a loss of value of that actual currency. Now, meaning that your money buys you less. Now, this is why 100 rands in 2025 does not feel the same as 100 rands back in 2010. Now, do you remember how much money you used to carry back in primary school? Now think about how much that money will buy you in today's world. Absolutely nothing. Because over the years, every time a new loan is issued, it reduces the value of the currency that is already in circulation. In essence, banking inflates the money supply. And inflation is the silent theft to your own purchasing power.
Mo Africa, a quick reminder that the paper in your pockets will perish. Gold and silver have stood the test of time. I am protecting my family and our stokvel savings by accumulating gold and silver coins to ensure that I benefit from the biggest wealth transfer that's coming. Now back to the episode.
But here is the real kicker. I'm sure some of you might have heard certain experts saying, yes, loans do create currency, but when these loans are repaid, that essentially reduces the amount of currency that is in circulation, and therefore the effect is neutral. Well, that is partially true, but it negates a very important principle which we refer to as interest. Yes, when the bank loans you 1,000 rand, you don't pay them 1,000 rand only, you pay them their 1,000 rands plus the interest that they will charge you on that specific loan. Now, this interest portion of the repayment is also contributing to the increase in the money supply. But there is no specific counterbalance to reduce the money in circulation by the equivalent amount as it relates to the interest charged. The interest is essentially retained by the banks as their profits, and by that they also increase the money supply or the money that is in circulation. So what's the bottom line here? Every time that you take a loan, every time that you swipe your credit card, you are not just borrowing money. You are essentially participating in currency creation and the silent theft of everyone else's purchasing power through the evil of inflation. Thank you for joining us on another impactful, exhilarating episode of the Money Revolution. Now, if you found this valuable, particularly with how we discuss how easy it is for banks to just print out money out of thin air, please share your comments in the section below with us and also subscribe to our channel. To get notified on our new uploads, hit the notification bell so that you stay in the loop. Let's wake up the masses. Let's understand how money really works and take back our power one conversation at a time. And remember, if it's paper, it will perish.